Good afternoon, everyone. Welcome back to this week, a Tuesday edition of Weekly Market Review. As usual, today I have with me Mr. Gerald Wong joining me on the show today. How was your long weekend, Gerald?
It was good. Had a good rest. And also managed to catch up on some of the developments in the market. It's been a very busy week. I remember at last week's Ask SIAS, Sunny, you were talking about having to monitor the CPI data that was coming out, having to monitor the Fed meeting. So how have we actually seen the market reacting since then?
Yes, so I think market did have a very good run last 2 weeks, I see. From the last Wednesday conversation that we had on the ASEA that I'm watching, or the CPI. The CPI data actually come out softer, and then we also have a softer PPI data as well. So that means that I foresee there might be some changes to the probabilities of the Fed interest rates. So maybe you would share some of those insights with us today.
Yes, so I updated some of the charts yesterday. I'll go through during today's weekly market review. Okay, as usual, today's sharing is for information purposes only. It should not be taken to be financial advice. If you find the session helpful, do leave us a review on Google. And if you'd like to join SIAS as a member, you can go to this website or scan this QR code. The membership for SIAS will cost $12 per year or $1 per month. Okay, so what we saw in the past week was good news for US stock investors. The S&P 500 reached another record high, now above the 5,400 levels after the 1.6% gain last week. Okay, as we can see, the gains are mainly led by the tech stocks, since the Nasdaq was up by 3.2%, while the Dow Jones was actually down by 0.5%. We also saw the STI having some slight losses, now down to below the 3,300 level. So acting quite in line with what we see for the Dow Jones and missing out on the rally in the S&P 500. Okay, so the big news that came out, and that was what Sunny was looking out for, is really the CPI data. This gives us a sense of the inflation trends in the US. And we saw that the May data that came out was below market expectations. And as you can see from this chart here, there's a very clear trend that the core CPI has been declining over the past year. Okay, so from a high of above 5% back in May, it is now down to 3.4% in the month of May 2024. Okay, so with that, we saw the US bond yields coming down. Okay, this is the 2-year bond yield. We see a slight decline in the US 2-year bond yield following the announcement of the CPI data, given that investors are now expecting that there might be more chance that the Fed will cut interest rates this year. Okay, so this is exactly what we see for the CME Fed Watch tool. Okay, it's something that we have been sharing quite regularly to get an understanding of what are investor expectations around rate cuts. So we are now almost close to the end of June. There are 4 upcoming Federal Reserve meetings for the rest of this year. And what we see here is that based on the update yesterday, investors are now expecting 2 rate cuts in 2024. Okay, so potentially the first one coming through in September, and then potentially another one in December this year. If you have been following our weekly market review, just last week we saw that investors were expecting that there might just be 1 rate cut this year after the very strong jobs data, but effectively the inflation data reversed that. Okay, if you're to look at the Singapore market top performers, we see Yangtze Shipbuilding once again. It's been making the list of the top performers for, if I recall correctly, the past 3 weeks. And if you'd like to get an update and why the share price has been moving higher, this was something that we covered at last week's weekly market review. Okay, in terms of the worst performance, quite a number of stocks that saw declines in the past week. We've got Mapletree Pan Asia Commercial Trust down by 3.2%. Some of the developers have been pretty weak as well. So CityDev down by 3.5%. As well as the Jardine related names, we see Jardine Matheson down by 3.2% and Hong Kong Land down by 5.8%. Okay, I think what a lot of investors are watching very closely for is OCBC's offer for Great Eastern Holdings, or GE. I just wanted to share some factual information to be able to provide investors with an update around what is happening here. Okay, so in a nutshell, OCBC has made an offer for GE shares at 25.60 per share. Prior to the offer, OCBC owned 88.44% of the shares of GE, and the intention of the offer is actually to delist GE. Okay, in terms of the rationale of the transaction, what OCBC really hopes to be doing is to solidify its wealth management position. So this will help to reinforce its vision to become Asia's leading wealth management player. Okay, OCBC also believes that this will be effectively allocating its capital in a more optimal way. So as a result, what it hopes to be able to do is to deploy the capital in this business that it believes is attractive and valuable, and thereby generating greater returns for OCBC. Okay, in terms of the offer price, we saw that it is 25.60 per share. Okay, this represents a premium over the share price of GE on a volume-weighted average price basis over the past 1 month, 3 month, 6 month, as well as 12-month period. Okay, if you were to look at the implied multiple of the offer, on a price to embedded value basis, okay, based on the last traded price of GE prior to the offer, GE was trading at 0.51 times price to embedded value. Based on the offer price of 25.60, it would imply a valuation of 0.7 times price to embedded value. Okay, in case you're wondering what embedded value is, this effectively represents the value of all its future profit. So that is seen as a measure around what this company is worth. If you're to look at it from a price to book value perspective, then based on the offer price of 25.60, that would represent 1.54 times price to book. Okay, and last Friday, we saw that the independent financial advisor, which in this case is Ernst & Young, they have come out with the report on the transaction. And based on the opinion of the IFA, they have the view that the offer is not fair, but reasonable. And based on this view, they have advised the independent directors to recommend that shareholders accept the offer. Okay, and the independent directors of GE have concurred with the IFA's assessment of the offer and recommend that shareholders accept the offer. Okay, in case you're wondering what does this not fair but reasonable actually mean, I'll go through some of the considerations that the IFA had in coming up with this view. Okay, so first we start with the view that the offer is not fair. Okay, so there were a few considerations that came through. The first is that the offer price of 25.60 per share, this is lower than what the IFA has come up with in terms of the derived range of values of GE, which they deemed to be approximately 28.87 to 36.19 per share. Okay, so because the offer price is below what they have derived in terms of the valuation, this is one of the factors that has led the IFA to take the view that the offer is not fair. Next, the price to EV ratio implied by the offer price of 0.7 times, that represents a 30% discount to the embedded value of GE as at 31st December 2023. And what the IFA believes is that it does not ascribe a value to GE's value of 1 year's new business, which is the value that it can potentially create in 2024. Okay, next, if you're to look at it from a price to NAV basis, this effectively would imply a valuation of 1.5 times, and that is below the average and median price to NAV of comparable transactions, which is at 1.8 times and 1.9 times respectively. Okay, so with this combination of considerations, the IFA is of the view that the offer is not fair. Okay, next, we look at the factors that the IFA took to come up with the view that the offer is reasonable. So a number of considerations. First, if you're to look at the price to EV, earlier we shared that that is a ratio of 0.7 times, and this valuation is above the average and median daily price to EV ratio of 0.57 times and 0.53 times for the 5-year period before the announcement date. Okay, so this is one of the factors that actually led the IFA to take the view that the offer is reasonable. The next factor, the price to EV ratio of 0.7 times, that is actually in line with the average and median price to embedded value of comparable companies. Okay, and this is what we see in the table here. The average is at 0.7 times in terms of the price to EV ratio that the comparable companies are trading at. And in terms of the median, it is at 0.6 times. Okay, just a few regulatory issues that we need to be aware of from a shareholder perspective. Okay, so if the total number of shares held in public hands fall below 10%, okay, trading of GE shares on the SGX may be suspended. And in this situation, shareholders who continue to hold their shares will not be able to transfer their shares without the prior approval of SGX. Okay, next is from a regulatory perspective, the SGX Regco requires companies seeking to delist to provide shareholders with an exit offer that is both fair and reasonable. As such, based on the IFA view that the offer is actually not fair but reasonable, GE may not be allowed to delist in conjunction with the current offer, even if trading in its shares is suspended. Okay, so this is all factual information. It is not a recommendation to take any form of action in either way, just to share what we have seen coming out from the IFA report and what are the regulatory issues that we need to be aware around this offer. Okay, so for shareholders who wish to accept the offer, but who have not done so, you would need to sign and submit the relevant acceptance forms, and that actually needs to reach the offerer no later than 5:30 p.m. on 12th of July. OCBC has also come up with a statement last Friday to say that the offer price is final and it does not intend to extend the offer beyond the final closing date. Okay, so that in a nutshell is the update on the OCBC offer for GE and what we know at this point in time. Okay, next I'll just touch briefly on Capital Infrastructure Trust. This is a name that a lot of investors have asked us about, and I just wanted to share some updates on this company as well. So what we see here, the share price of Capital Infrastructure Trust has come down from above 50 cents at the start of the year to 46 cents as of last week. Okay, so for those of you who may not be familiar with this name, KIT invests in infrastructure assets in developed markets that provide stable cash flows. And if you're to look at the assets that it has asset under management of about 8.8 billion following the recent completion of an acquisition in Australia. And if you're to look at the breakdown of the assets, as we mentioned, it is in developed markets. Singapore would represent the bulk of the assets, where it is about 20%. But we also see that it's got sizable exposure in other markets as well, such as in Saudi Arabia, Australia, and New Zealand, as well as in Europe. Okay. If you're to look at the segments that these assets will be in, energy transition will be where the bulk of the assets actually reside, and that is where the company generates the cash flow to be distributed to unit holders. Okay, over the past 2 years, we have seen that Capital Infrastructure Trust has been able to generate stronger earnings, okay, as measured by the EBITDA. This comes through from better earnings from the existing assets, as well as some of the new acquisitions that the company made. Okay, in terms of how the company has been distributing the income, what we see here is that in the previous few years, the amount that the business trust has been distributing is below the level of the distributable income. Okay, and what we see for FY23 is that the amount distributed was slightly higher than the distributable income. And what does this actually mean is that that included a special dividend of 2.33 cents per unit, and it came through from the capital optimization exercise that the business trust was actually undertaking. Okay. Overall, we see that the distributions per unit has been increasing over the past 3 years. Excluding the special dividend that was paid out last year, what we see is that the distributions are expected to increase, and that may potentially imply a distribution yield of close to 8.9% by the time we get to 2025. Okay, so I've shared some of the key updates in the market in terms of what we are looking out for in the week ahead. I shared earlier about some of the developments around OCBC and GE. There's an event that's coming up on 20th of June, this Thursday, to keep a lookout for. SIAS is hosting a dialogue with OCBC for GE shareholders. So if that is something that you are interested in, do make sure that you sign up for the event. Apart from that, SIAS is also hosting a webinar as an introduction to bonds on Wednesday, 19th of June. And for those of us who are T-bill investors, there's another upcoming T-bill auction this Thursday on the 20th of June. Okay. With that, I'll hand over to Sunny, who will share some of the trends in the market with us.
Hey, thanks, Gerald, for that update on GE and KIT. I think the GE topic is what a lot of people are concerned about, and a lot of SIAS members are also keeping a close watch on. So do stay tuned to the 20th July event and look at what are the updates that's coming up with the dialogue organized by SIAS between OCBC and GE. Okay, so let me touch on what happened in the markets on the indices in the past 2 weeks. We can see that STI has a pullback since touching the 3350 level. The high was on 3rd of June at 3,355 points. That was the 3350 resistance level that we have been eyeing on. And since then, since the beginning of June, the past 2 weeks, we can see that the STI index has sort of retraced back to the lower bound of the Bollinger Band, currently around the level of 3,298, or I would say the 3,300 level. That is the support level. That's the first support level that we are looking at. And on this Tuesday morning, we can see that STI has sort of a pretty significant rebound, up 14 points on Tuesday morning, or about 0.4%. So this is what we carry forward from last overnight gains on Monday night on the US indices, where US indices continue to power upwards. So where are the key levels to watch out for on the STI index? Firstly, I believe what attributed to this pullback was just market thought that there might be limited upside, and hence they are taking some money off the table. So a bit of a pullback is is expected and reasonable. So there's not much key concerns about this pullback that we've seen since the beginning of June. It may also be the concept of sell in May and go away. In Singaporean context, we always have the June school holiday, so there might be less activity and some traders might want to close off position to go for an overseas holidays over the long weekend. Hence, there may be a pullback. So this pullback is actually not really unexpected, so it's healthy. And you can see that it's actually bounced today at the lower bound of the Bollinger Band. So the key support that I'm looking at right now, the next one would be around the blue color line that you see here, which is the 50 days moving average, now around the 3285 level. Because at this level, if traders were to get back in again, and then the target would always be the 3350, because that is the last known resistance that we see, that would give a healthy margin for traders to trade in, at least even if they are short term or a kind of a range bound trading pattern starts to develop. So if we go further down, that would be the 100 days moving average at 3248, or I would call it 3250 level. So where would I be placing or staggering my entries? Definitely around the 50 days moving average towards the 100 days moving average, which is around this level. And you could be, we could actually take a look at STI once it goes below the 3,300 level. Currently it's at 3312. On the indicator wise, you can see that since the beginning of May, the MACD indicator has been showing sign of a topic signal. You can see that the trajectory of the MACD line and the signal line since the May period has been trending in a horizontal sideways directions. And once it hit the 3350 resistance, you can see that actually the MACD line crossed below the signal line significantly. And now we have a negative MACD reading, which shows that there is still negative momentum in the STI index right now. So there's no rush to get into the market at this moment. At this point, I believe anything below the 3,300 would then start to attract traders to come in again on the STI index. On the RSI indicator, we have also fallen below the 14 days RSI reading of 57 somewhere at the beginning of June. And since then, market has been trending downwards in the past 2 weeks. We hit a low of the RSI reading, hit a low last Friday to the 46 point level. And today we are up on to 51 points. So that means that if this long-term uptrend of the STI since the beginning of the year were to continue, the RSI would likely want to stay above the 50-point neutral mark in the upper range of the RSI reading. So with these readings, I believe definitely the long-term uptrend of the STI is still intact. You can see that in the early part of the year, the moving averages seems to be crisscrossing above each other. But once we hit the May period, you can see that the 20 days moving average in green, then the 50 days in blue, 100 and 200 days moving average in amber and red respectively, has started to take their position accordingly to where their moving averages are. And hence, that is also another reason why I feel that this uptrend that we are seeing based on the trajectory of the various moving averages having in line and projecting an upward trend is likely to prove that the STI will have a sustained upward movement towards the second half of the year. So I'm looking forward to accumulate the STI between the 50 days and 100 days moving average. That is around the 3,300 to the 3,250 points level is where I will try to accumulate more on my STI position. Okay, so next, let me move to the US indices. So we have one more reading yesterday on Monday night. Okay, so you can see that for the Dow Jones index at least, right? There is a little bit of pullback on the Dow Jones index because we have seen that at the beginning of the month of June, we saw that the non-farm payroll data was pretty good. Hence, the rate cut, which Gerald talked about earlier, was like a cut to 1. And then now that we have the softer CPI and PPI data last week, market seems to be returning back to the 2 rate cut expectations again. So we are flip-flopping between the 1 rate cut and 2 rate cut scenario. And if there's 1 rate cut, you can see that the Dow Jones pull back. And once we see that the CPI data and PPI data came in softer than expected, and the market returned back to the 2 rate cut expectation, market starts to rebound again. But then again, on the technical front, you can see that the amber line over here, the 100 days moving average seems to be a good support level for the Dow Jones Index. Somewhere in the April period, we also touched this level and market rebounded strongly. So we are now testing this 100 days moving average level again, and this could provide another support for the Dow Jones Index going forward. Okay. So looking at the indicators, you can see that the MACD indicator is negative right now, and the trajectory seems to be going sideways and is still below the 50-point baseline. So I think market will still be pressured towards the lower bound of the Bollinger Band. That will give you a range to play with for the Dow Jones Index. And the Bollinger Band basis or the 20 days moving average is now around the 38,880 points level, with the lower bound of the Bollinger Band at 38,025 points. So the 38,000 handle will be the key level to watch for a big strong rebound for the Dow Jones Index. Of course, if it goes below there, the 200 days moving average is standing at 37,399 points. That will, of course, be a more attractive level, but you should be considering getting into the Dow Jones Index somewhere on the lower bound of the Bollinger Band at 38,000 handle, which could be a psychological level that I feel a lot of traders might be interested to get back in on the Dow Jones Index. Okay, on the RSI indicator, it's slightly weak right now, just 2 points below the 50-point neutral mark. So that means that there is not much of a momentum in the Dow Jones Index right now, and it could possibly trend in a sideways movement in the lower bound of the Bollinger Band in the coming 1 or 2 weeks. Okay, next let's move to the broad index of the S&P 500. So if I remember correctly, this is like a new record high, what Gerald said earlier. So we do have a sort of a negative session on last Friday, but then we can see that the market rebounded pretty strongly last night. So that means that the uptrend is likely going to continue. The momentum is carrying upwards. You can see the moving averages are also queuing in line, and the trajectory seems looking towards further upside. So that means that upward momentum is likely going to continue to sustain towards the second half of the year. But the key levels that we are watching, of course, definitely we wouldn't want to get in at the top of the Bollinger Band, the upper bound of the Bollinger Band, because that means that there could be a lot of resistance over there. We will likely be on a more conservative note and look for a pullback towards the 20 days and the 50 days moving average before considering getting into the S&P 500. So don't need to chase the rally. The market will come back to you like what we observed somewhere on the end of May as well as the end of April. Okay, so the indicators wise, you can see MACD indicator is still very strong. It is still trending upwards with the divergence of the signal MACD above the signal line. So the uptrend is likely going to continue, and for the next resistance level, as of now, besides using the upper bound of the Bollinger Band at 5461, there is no further indication of which resistance level that might be, because we are at an all-time high. The RSI has also breached the 70-point mark, which is now reading at 75. So that means that the S&P 500 is over elevated right now, and the RSI is in the overbought territory. So also that's what the RSI is telling us, that there could be a retracement coming soon, since the index is in the overbought zone, like what we saw in the January period as well. So with the MACD and the RSI sort of having contradicting signal right now, it would be best for us to wait for more data points to appear, to develop before we decide on the next move. So let's say if the MACD were to start converging towards the signal line again, that would coincide with what the RSI is saying, and then a pullback towards the 20 and 50 days moving average would be more highly likely expected in the near term. Okay. Next, let's move to the leader of the 3 major US indices, I believe, which is the tech stock. I think besides Nvidia, Adobe also was the big performer last Friday. I think it rose about 14%. So I believe tech stock, I would always call it tech stocks are productivity stocks. And when you talk about productivity, they are making money for the company. So there is no surprise, and I also have position in the Nasdaq Composite Index for a very long period of time already. I believe long-time viewers of us would have seen me talking about the Nasdaq Composite Index quite often. So I am very pro on tech stocks, and hence I also have position in the Nasdaq Composite Index. As of now, you can see that Nasdaq Composite Index is also on the upper bound of the Bollinger Band. That means that it's not a good time or to get in around this level. We are trying to see if the Nasdaq Composite Index retraces back down to the 20 days moving average, now standing at around 17,149 or 17,100. Okay, depending on whether you are reading the EMA or the simple moving average. You can see that during the early part of June or late part of May, we also touched this level and then we have a big bounce up. So this is those kind of patterns that I'm looking out for to give me more conviction on getting on some of the indices or the stocks. So I'm waiting for the Nasdaq Composite Index to trend back down to the 20 days moving average before accumulating. So key levels to watch, of course, will be 17,100. And of course, the next one would be the 50 days moving average, which is now at 16,681, with the lower bound of the Bollinger Band at 16,400. Okay, MACD indicator, very strong right now, very positive reading with the divergence of the signal line, MACD away from the signal line. That's a positive signal. And the RSI going deeply, highly above the 70-point mark, which is the overbought zone. Hence, again, a contradictory signal between the two indicators. So it would be better to hold off the entry now and wait for a pullback where the indicators coincide with each other again before we get on a firmer ground to get back on the indices. Okay, so that are my observations this week on the indices. So anything to add, Gerald?
So again, we have had quite a lot of movement in the US market over the past week. It's getting to a quieter period for the company earnings, but still we have quite a number of corporate developments that are ongoing. I guess in Singapore, a lot of investors are looking out very closely for the OCBC offer for GE shares. So once again, if there's something that you are interested in, do keep updated around the developments there, including the upcoming event that SIAS is organizing as a dialogue for GE shareholders with the management of OCBC.
Yes, and I think that is the time that we have for today. I'd like to thank Gerald again for giving us all the updates on the markets and helping us to understand the market better. So as usual, everyone, do trade safe and stay safe, and we will catch up with you next week on Monday in the next weekly market review. Goodbye.
See you.